He's an award-winning executive and seasoned industry expert. He's recognized by industry peers for inciting positive change and growth within the industry. He's past president of the Canadian Mortgage Brokers Association, the Ontario Board of Directors. And since entering the industry, the mortgage industry in 2008, he's been focused on positively disrupting the sector by leveraging technology and artificial intelligence, ensuring to put, obviously, the consumer at the heart and forefront of his business. What's not on his resume, my friends, is that, well, we were classmates back in the day, and, well, we won't talk about who actually outranked the other in performance in the class. But our guest today on Hitting Home with Mike and Arif is Shubha Dasgupta, CEO and co-founder of Pineapple. Welcome to the show, Shubha.
Welcome.
Thank you guys so much for having me here. It's my pleasure.
Absolutely, and it is great to have you, and it's great to see you after a few years. And you've gone a long way. You've gone a long way since our days in school and going through all of the technical and theoretical, and you've put it to work, and you've been an advocate within the industry, well respected. So it made sense to Mike and me to have you on the show. We've had a number of experts on the show over the years, and some very prominent ones, and we figured, you know what, who better than someone who has their finger on the pulse of what's going on in the industry and leading the charge in terms of technical advancement than you. So I am thrilled to have you on the show, Shubha.
It's my pleasure, my honor. And, I was thinking about dusting off some of those old notebooks from back in school, but I don't know how relevant that would be today.
Interesting. A lot has changed, obviously. A lot has changed, certainly, and we'll get into some of that today, technology being one thing, and that's something that you've obviously put your hands on and focused on in your business. I would assume many of the principles remain the same, but I think that's what we're here to talk about is, how have some of the practices changed and how do they serve, given, obviously, the last few years has seen a lot in terms of changing environments and the way both institutions and professionals and consumers work together and collaborate within the industry. So why don't we get right into that? Let's actually get right into that very point about technology. Over the years, we've seen historically low interest rates, and we might touch on that just a bit, but how has technology, which many people think is actually impersonal, how has that helped you and brokers and professionals within the industry to keep it personal and more client-centric?
One thing that we've seen over these last few years, the industry has changed more probably in the last 5 years than in the previous 5 decades before it. And although we're a technology company, one of the things we always say is that we're a people company first. And it's very important not to build and create technology to replace people, but rather to empower people. And I think that's the biggest difference and change that we've seen here in terms of implementing technology into the business and into the mortgage landscape. It's been to empower consumers to provide a better customer experience, to allow a more seamless, engagement in what is a very daunting process for most, right? Getting into home ownership is hard, and it's confusing, and it's new to so many. So using technology to help empower them to get more knowledge, a better experience, and just a more smooth process. And then on the back end, really using technology to enable productivity and efficiencies. So, increasing turnaround times and responses, making sure that we can shrink the timeline for the entire mortgage process and help make sure it's more secured and friendly, really, is the best way that I can explain it.
Yeah, for sure. And I would echo that with the real estate industry as well. And certainly the last 3 years with the pandemic provided opportunity, if you want to call it that, for us to embrace that technology, not just at the back end, but certainly as a communication tool and a way to stay step by step with your clients all the way through. And I think that's going to carry over beyond the absolute need for it through the pandemic. I think it's become an active part of the way we do business.
We've been talking about it on the show for a fair amount of time, is that you're right in the sense that for the last 5 decades compared to the last 5 years, we've seen an incredible amount of change. However, one thing is that the conversation is around, has the industry chosen to keep up? Because there's been so much, this is the way we've always done things. In the last 5 years, let's call it in the sort of pre-pandemic years of the last 5 years, change was coming anyway, but at a much slower pace. And in the last 2 years, Shubha, would you agree that that was just catalyzed by necessity, or how would you describe it?
One of the hardest things about change is it's always the mindset towards it, right? So how do we feel about change and what's going on around us? And the last 3 years has really allowed us to accelerate the mindset of change. It's allowed us to be a lot more open and accepting to using new technologies, new systems, adopting a different way of life. Yeah. And you just said it best. We got so used to the status quo that we forgot to imagine the way things could be. Should we put a little bit more work? Should we innovate? And should we drive positive change? So I certainly think that the last couple of years has been a driver of that mindset shift, and I think it's going to continue to carry on in the years ahead.
And as a marketing tool, as an educational tool, the internet, it's always been embraced, but never more so. Online shopping, it was there prior to the pandemic, but I think more and more of us have embraced that, and that may play into a lot of things we may talk about with the need for rising interest rates as we get into that, our shopping habits, how they've changed for sure.
Absolutely. Shubha, you referred to yourself and your company, though, as a technology company, which I think is quite telling, and I think it's very appropriate. As you know, I've also delved into that, and there's a lot of marketing involved in technology and embracing technology. And I love how you posed it, though. We are in a very legacy style industry, and banks are probably the slowest to change, while the Attorney General forced change within the court system and access to justice and access to courts, and allowing what we refer to as digital signature versus wet signature. Even industry still was slow to change. A lot of their architecture is 30 years old. We look at banks as being these modern with it things, and in fact, behind the scenes, they're very old and outdated. The reality is, though, in my opinion, is that the consumer has wanted change. We embrace our cell phones, we embrace our iPads and technology, and as consumers, we do a lot more research. We access search engines and Google, et cetera, and we want access to the information before we make a decision. And so it only makes sense that our industry change. So yes, you're a licensed broker and you run a brokerage. However, you've embraced technology because that's what the industry wants. That's a leading comment.
That's what the people want, right? The people want a different experience. I was at a conference recently this past week, and the way that I began my presentation there was to imagine the greatest memories that you have in your life. And for most of us, we'll remember something that happened in and around our homes. This is a special place to us. Yet the process to get into a home is so difficult and so arduous. Yeah. So technology was not a need, or it wasn't what we wanted, or it wasn't by design. It was what the consumers have been asking for, because they wanted home ownership and they wanted an easier path to get there. And that's really where it all stemmed from.
Yeah, and we have a millennial generation that's quicker to embrace, and for them, technology's always been there, and they will carry it forward. I don't think there is any going back to some of the bricks and mortar style of doing business, our business, mortgage business, any business.
I think, Mike,
this is the way we're going.
With that in mind, though, Shubha, as somebody who's been actively involved in the advocacy side of things with the Canadian Mortgage Brokers Association, tell me, with the over 12,000, I don't know what the number is today, licensed individuals in the industry, we saw back in 2008 when the government and the regulator instituted or mandated licensing, we saw pretty much a drop-off of people who said, you know what, I've had a good run, I'm not ready to embrace that change, and they allowed their licenses to expire. They pretty much resigned from the industry. Is it the same thing with embracing technology? And again, maybe you can separate yourself as the CEO of Pineapple from being a past president and a very active advocate within the industry. What are you seeing between one, the banks versus the broker channel? We'll refer to it as the non-institutional, non-big six banks in terms of accessing mortgage financing. So those consumers who access their financing through a mortgage agent or a mortgage broker. And as well internally within the industry between those who maybe are less willing to embrace change and those who are more willing to embrace change.
Yeah, I think there's two sides to that question, right? And you know, if we start at the first one there, just on the broker versus the bank side of the business, you know, I don't actually look at it as broker versus bank, because the broker channel is actually an extension of the banking channel. You know, through some of the big six banks, we offer their products and their solutions. So it's really all of us working together to provide the best solutions for, you know, Canadian home buyers and homeowners. But as the years have gone on, we've seen definitely a demographic shift in what customers and Canadians are looking for, with more of them leaning towards the broker side. You know, a few years ago, when I first started in the business, and when you and I kind of finally graduated school, broker market share was sitting roughly at about 25%. Now, unofficially, that number surpassed the majority last year. You know, some reports are showing 51% of all mortgages originated in 2021 were done through the broker channel. But when we dive a little bit deeper into those statistics, we can see that about 65% plus of first-time home buyers would prefer to get their mortgage from, you know, the mortgage broker channel. So we're seeing a lot of this younger demographic certainly be attracted to a more personalized solution that has access to a variety of options, as you referred to already. You know, and then when we kind of rewind that back to, you know, the banks versus the broker channel right now, I'll actually break it up into three categories. So we'll say banks, you know, traditional mortgage industry, and then more of the new age, you know, technology driven digital mortgage companies. And I kind of always use the analogy of transit when I try to speak to this, to try to simplify it. You know, when we look at the infrastructure that's built in and around our cities today, it's an infrastructure that's hard to change, right? We have, you know, transit lines, water lines, sewer lines. And as we begin to grow and advance and innovate, you know, we have to rebuild infrastructure. But it's not infrastructure that's easy to rebuild. I mean, you know, you've seen over the last decade, even laying fiber optic line across the province has been, you know, a task and something that we've worked on very hard. Well, the same goes for technology. You know, companies that have been in existence for a long period of time have older technology infrastructures, and just like older subway lines, we have to rebuild and redesign that in order to meet the needs of this changing landscape. So that's where some of the newer digital mortgage companies certainly have an upper hand, because they're building this architecture and this data structure right from the ground up. So they're using more advanced technologies, technology that's more, you know, adaptable, and that's really more acceptable to what we're looking for today. So it'll be interesting to see how this progresses in the years ahead, as some of the older companies, albeit, you know, longstanding, credible, and very strong organizations, they have a task ahead of them to be able to convert their older aging infrastructure into more newer infrastructure.
So I think, Shubha, I mean, obviously you're very well researched in that, and that's something that you and your organization has committed to. When we come back from the break, let's get into how much of that is going to be recognized by the consumer, and how much of that is going to be sort of speedy legs keeping the duck afloat underwater, you know, and being done on the back end. So we do have to go to break real quick, but when we come back, we'll have more insight and finger on the pulse information from somebody who's definitely prominent and leading the charge within the mortgage industry. Shubha Dasgupta, CEO of Pineapple. Thanks for being with us. We'll be right back after this short break. Welcome back to Hitting Home with Mike and Arif, and this week we are thrilled to have my good friend Shubha Dasgupta, President and co-founder of Pineapple and past President of the Canadian Mortgage Brokers Association of Ontario. Glad you're with us, Shubha. Before the break, we were talking about really the relevance and the rise of technology and how the landscape continues to evolve, always with the focus of bettering the customer, the consumer experience through technology. And the question that really you left me with, obviously, is there are different demographics out there. There are people who are more and less comfortable with technology. However, one of the things that I'm sure we have to be mindful of is the more access to technology, the more opportunity for those who operate in a different sphere to commit cybercrime, if you will. Security issues. And so what are you noticing there in terms of consumer behavior and acceptance or apprehension in using technology to access mortgages?
You know, the first thing that I think I'll touch on, you know, back in 2018 or 19, we were at the Digital Mortgage Conference in Las Vegas, where one of the largest mortgage servicing companies in North America ran a massive consumer survey. And what they were asking was, you know, how many people would be, you know, really okay with a fully digital mortgage experience. And the results are very shocking to us, even as a company that was building technology in this space. The results showed us that over 80% of millennial age or younger were not okay with a fully digital mortgage experience. What that really showed us is that we had to empower people in the process, because people were the trust. People were what gave them the confidence and the comfort in validating decisions that they were making, you know, regarding some of the largest liabilities of their life. And coming back to that sentiment, and why I start my answer with that sentiment, is that it's all about that trust factor. And although technology opens the door to cybercrime opportunities, technology closes the door on a lot of other fraud activities and a lot of other misrepresentation. You know, right now we're able to track and monitor IP addresses of documents that are being sent via secured portals. So now there's no documents that are flying across via fax where you don't know who's going to get your document on the other side, or documents flying over email that might be way less secure than these secured individualized portals. You know, when we're sending information to banks, it's in a very secured environment, so less misrepresentation. You know, we're very proud that one of the things that we're trying to do with technology, and that we are doing with technology today, is actually minimizing fraud and minimizing security risk in the mortgage industry. So yes, as it opens up the doors to potential, you know, cybersecurity and hacks, it closes the door on so many other things.
Yeah, and those doors are being closed at a faster rate, I would say. I mean, sure, the bad guy gets wiser with time and finds innovations, but I think they're losing the war. I just read something this morning as I was preparing here that I think it's CNET in the States. They believe within the next year or two we'll be beyond the password as for access and security on the internet, and it'll be all, you know, retina and thumbprint technologies and you know, what do they call it, repetitive or identities, where it goes to your phone, so for securing things.
Oh, like two-factor authentication.
Yeah,
and
two-factor authentication. So we are getting better, and it's getting more secure as a result. And yes, that has been one of the challenges, is people not feeling safe online, and maybe people have had a bad experience, but we're getting through that for sure.
Well, I think if you look at consumer behaviors, I don't know what the number is off the top of my head, but you know, more and more people are accessing their goods and services, whether it's through the Amazons of the world or e-commerce shopping and transactions, et cetera. So no, I think we are going to cross that, and I think technology is in place to assist with that. You're absolutely right. I mean, the amount of fudging that could go on when you're using analog processes is mind-blowing, and we've all seen that. In fact, we took courses on that, if I remember, on how to identify when things have been altered, intentionally altered. So certainly that is the case. Now, what about the regulators involved in this, and how receptive have they been to embracing change in technology, Shubha?
You know, the regulators are open to accepting it and embracing technology, but the regulators definitely follow what I'll call a little bit of a slower process in terms of, approving it and really understanding the full implications of it. Um, Sometimes it's for the better of society and protection. I mean, the intention is always clear in that it's to protect consumers and protect our citizens, but sometimes it goes a little bit slower than necessary. And I think that, right now we're in between a crossroads where the industry is shifting, and it is changing into a more, digitally empowered environment. I don't think it's a fully digital environment by any means. People need to be involved in the mortgage process, both from a consumer facing perspective, as well as from a checks and balances perspective on the back end. And our regulators are certainly going to have to work with moving this needle forward. The first thing that I think was a positive sign of this was, as you said, the acceptance of digital signatures versus the wet signatures. For mortgage lenders and banks to be able to accept that was certainly a step forward. Now being able to open up channels of communications through, technology integrations and APIs to deliver documents and deliver information to them. That's kind of the next stage, right? So we're slowly progressing, and we'll certainly move in the right direction.
And the speed with which we can conduct our business is getting better and better. And I think of just doing a title search on a property, finding out, are there liens against the property, are there any clouds on title. That was a process that took far longer, and it was done manually earlier in my career, but now it's a much faster, and I would like to believe far more accurate, less susceptible to failure process today because of technology,
Yeah.
for sure.
And Mike, I think something that you would appreciate, something that's always been, front and foremost for our organization is really bridging the gap between mortgage financing and real estate purchases.
Yeah.
I mean, the two go hand in hand. And to me, it just makes sense that the process works collaboratively together, to really give a more seamless experience to that customer.
Yeah. And there's a ways to go with that, but we're moving in that direction for sure, and I like to see that for sure. That's to the advantage of the customer.
Absolutely. So the one thing, though, that I will bring up, Shubha, because again, I really loved your opening comment on the matter, is that you've recognized that that technology, when utilized appropriately, is there to support, and I believe you used the word to empower both the professionals within the industry to deliver better service, but also the consumer to access a better, superior, more accurate, more user-friendly experience and transaction. So to those who are in, and I'm looking for your thoughts, because again, if you look at it, so much of this, it's a very competitive landscape, and so much of this is driven by marketing efforts and initiatives. I won't name the blue bank out there, but you frequently see advertising, whether it's on social media channels or with other media platforms, that basically say, get qualified, get approved for your mortgage in as little as 30 or 60 seconds or 2 clicks or whatever it may be. And I have my thoughts on that, I have my opinions on that, but I'll certainly turn it over to you for an insider's perspective as someone who is leading the charge to ensuring responsible use of technology, including convenience. But tag, you're it.
Well, you know this, and you'll remember this from a lot of conversations and lunches that we've had together, is that convenience comes with risks, such as misrepresentation. So, getting qualified in 30 seconds can be a very dangerous statement to someone with a little bit of education, right? As they say, a little bit of information is very dangerous, right? So when you're entering the home buying world, without a proper review of a file and real understanding of your finances, getting that lead in to say that you're qualified for X when that may not be the case could put you in a potentially detrimental situation. So marketing does play a very big role in this conversation, but as you referred to earlier, and Mike was addressing as well earlier on today's segment, education is really what lives at the forefront of all of this. So making sure that we're educating home buyers and homeowners as early in the process as possible so they understand exactly what each step means. So understanding that a 30-second pre-qualification is it's a presentation of what you might be eligible for. And the next step is going to be to review some documents. And the next step might be for you to line up a property to correspond with this, and taking them through each stage seamlessly. I'm a big believer in telling you the whole story and transparency. And I think that's how technology empowers, our side of the business, because we can deliver education on levels that were, impossible before.
And I'm just thinking it's not necessarily technology related, but you were kind of walking the steps through the qualification. And I think something that with the shift in our market and the way the banking is being done of late, and that is the qualification of the home itself as part of that process. And Arif can speak to that a little more personally, a little more detailed than me, and maybe after the break we'll get into that a little bit, because we are in a shifting market. It is changing. Interest rates, for some of those millennials, they've never seen interest rates above 3% in their adult lifetime, but those of us older have seen the cycles, and we're in one of those cycles. The rates are going up, so let's get into that in the as we return.
Listen, Mike, I will tell you. I mean, I haven't done exactly done myself any favors when I come across on this show as the voice of reason and the voice of not caution, but as you said, Shubha, preparedness, the voice of being educated. And you're 100% correct, Mike. I mean, there are many people who are in this market who may be either entering into the market or looking at refinance, who are going to get a bit of sticker shock. And have they done themselves a disservice or a good service, and who you surround yourself in terms of your advisors and your guides? We talk about it on the show all the time. Everybody theoretically within reason has a dentist or a doctor or their favorite mechanic or their favorite plumber. But do you have your, and you may even have your accountant, but do you have your mortgage broker? Do you have your realtor, your go-to person who you are confident is ensuring that you've got the right information? So what we've seen in the last few years, certainly, and as recent as maybe 3 months ago, is surging prices, certainly pandemic-inspired surging prices in certain regions where people within the marketplace, if they're looking at the propaganda, have thought, if I don't buy now, I'll never get in, and if I don't buy this home today and go in over asking at 120% of asking price or whatever it may be, I may lose out on my opportunity. Just 10 weeks later, some of those people, and I don't want to create fear and panic, but some of those people are finding out that they can't even close the transaction because house value may have slowed down a little bit. The appraised value may not reflect that they're purchasing it what they agreed to.
After the break, because it's a great and it's a very informative story that you have to tell of an experience just this past week.
Well, then on that note, Mike, let's go to break real quick.
Hang in there, you'll want to hear this one.
Absolutely. And with that in mind, we'll be right back after this short break, joined by Shubha Dasgupta, CEO of Pineapple.
And we're back with Shubha Dasgupta of Pineapple. We're talking about everything mortgage and finance here today. And we alluded to something, Arif, that you had dealt with just within the last week or two with regards to a mortgage you're putting together and the appraisal that was done. Tell us all about that and
Absolutely.
what are the lessons there?
Absolutely, and you know, both of you, I'm sure, can relate to this story. Certainly, over the past several years, we have seen a steady increase in appreciation in home prices, and we hear about it in the news that both availability and affordability are issues within the industry. And of course, add to that a stress test, add to that some other things that might be pandemic related, and it's just gotten more interesting to either get into home ownership or to stay in home ownership. And I share this with my clients and also on the show more often than I used to perhaps, and that is that it's not enough just to get into the house, but at the end of your term, you do have to qualify to stay in your house. And that's not meant to detract anybody, but that's to make sure that the bank and you still continue to have what appears to be a a mutually beneficial relationship. So over the last couple of years, though, Mike, we've seen this continued increase in home prices and home values, and people need to do what they need to do to qualify. Mm-hmm. But we've also seen some peaks and some valleys, and in 2017 we recently saw a considerable surge in our region. I think we looked at about 42% increase, and then about 6 months after this buying frenzy, things sort of dropped off. Well,
corrected, yes.
That happened again just in the last, call it 10 weeks. We've seen a surge, certainly locally, in buyer activity. We've seen that people continue to leave the GTA and look at other regions surrounding the GTA, whether that's Milton area or Whitby or north towards Barrie and Simcoe County, or even out of province. And that's put pressure on the availability, the supply of available homes.
And in turn driven up the prices for sure.
But add to that mix, we are now seeing a war in the Ukraine. We're seeing the oil prices impacted. We're seeing inflation. We're seeing the impact of stimulus spending, otherwise known as essentially, in my opinion only, the federal government printing cash, therefore devaluing the value of a single loonie or a single dollar, and therefore creating inflation, which means what? In order to buy that same product that was worth $1, you're now spending that much more, and we're looking at about 7.7% inflation. So all of that,
Shubha,
Shubha,
back in the 80s.
Yeah, all of that is putting pressure on the market. Interest rates have gone up. Bank of Canada has raised their rates, and all of that has made it harder. Why? Because it only makes sense that the bank that needs to lend money out has to reflect their pricing similarly as we're seeing in groceries and gasoline and fuel prices, with that 7.7% inflation in mind. With that in mind, though, obviously we've seen some cooling off on activity in the market, and some prices have come down. And what happens basically is somebody who entered into an agreement based on negotiation, perhaps at the end of April, by the time they got their financing in place and an appraisal done on the property is worth anywhere between 10 and 25% less than when they negotiated the contract. That's the story, folks, that Mike, you were referring to. Shubha, you must be seeing something similar, or at least hearing about it. And what are your thoughts for the consumer, and how is the consumer getting that better educated guidance that you were referring to, and using technology in your services to ensure that they are entering into a transaction with eyes wide open?
You know, one of the analogies that I've been using over the past few months is the last couple of years, we've been driving 150 kilometers an hour on the 401 or on the 400, on a 100 kilometer an hour speed limit roadway. And these last few months, we've gone from this 150 kilometers down to 120. So although it feels like we're going really slow, we're actually still above the speed limit. Mm-hmm. And it's only just now, very recent weeks, that we're seeing, levels of buying activity and home buying activity kind of come back down to that average line, that 100 kilometer speed limit line, where we're all going at a pace that's more acceptable. So very important for us to remember that, because hopefully not a lot of us are going 150 down the highway, but when you put your foot off of that gas and you're going 120, it feels really slow, but you're still
Yeah.
going really
And
fast.
yeah, and just locally, add to that, I just read where interest, or not interest rates, sorry, but house prices are still 5% above where they were a year ago at this time. So we saw quite a rise in the past 6 months, and we've dropped back down some, but we're still above. And we're still on average, home prices are on average double what they were 5 years ago. So
But
nobody's really losing. But again, when you're coming in at this point, in the midst of this change, to put a mortgage together, to require an appraisal of a home, there's a lot of considerations that have to be taken into effect in a changing market, and lenders and appraisers are being a little more conservative, has been my experience.
Well, Mike, I will add to that, if I might, that first of all, I agree with your statement earlier that there may be as much as an entire generation of people, and maybe that's stretching it just a little bit, who've never seen interest rates where they are today, and people are thinking, oh my gosh, this is unaffordable. They weren't around apparently as a homeowner in the 90s. They weren't around pre-2008, but we have been in artificially subsidized interest rate territory since 2008, basically, if my memory serves me correctly. And the entire time I have provided guidance to clients basically saying it's artificially low. What does that mean? It means at some point it's going to correct, and you need to be ready. You need to have a buffer. So the question is, whose responsibility is it, and when are people getting this education that they deserve to make sure that not only can they get into the house, but they can stay in the house? And I am concerned about it with industry professionals or industry in general, because it almost seems like there's been a period of, what's it going to take me to get you into this house, and how much house can you buy for what you're earning, without, really taking into account that peace of mind and sanity and the protection of one's family and the security of one's family must take into consideration the realities of the data, and the data says that we were historically underpricing on interest rates, and now we're seeing, as you said, that speeding at 150 coming back to normal. Well, now we're seeing that artificially low interest rate coming back to normal, and are people prepared for that?
Yeah, so I think there's a few great points to touch on there, and the first one really being that, when's the best time to buy? When it's right for you, right? So really doing the right analysis, working with professionals, as you referred to earlier, Arif, working with the right real estate agent, working with the right mortgage broker, properly getting pre-qualified, having them review your finances, creating a budget to understand, how much your monthly expenditures are going to be, or how much that mortgage is going to cost you, and making a decision that's right for you. People buy in all markets. Good markets, up markets, down markets, and home ownership and a roof over our head is something that we all need and want and desire. So really just finding out what's right for you. Now, coming back to your point about the artificially low environment that we've seen for the last few years, something else that we've also begun to see in the last few weeks, during the last few years, during this low rate environment, what we saw was the regulators swing the pendulum into a very tightening of the market. They reduced some of what was easier mortgage qualifying rules. We used to have 40-year amortization. We used to have zero down payment. We used to have, less restrictive debt servicing requirements. You could refinance your property to 95%, no stress test. And over this last decade, essentially, we've seen the regulators really tighten all of those qualifying policies to make it harder and harder and harder to get mortgage financing. Now, as we kind of lean or swing into the next stage with rising interest rates, less affordability, the government does have a tool available to them, which is beginning to loosen some of that policy again. The stress test could be the first place to start. Right now, Canadians are qualifying fixed rate mortgages at about 7%, which is contract rate +2, versus a variable rate that they're qualifying at 5.25% right now. Now, that's dangerous, that creates what I call this 5-year funnel or variable rate funnel, where more Canadians are taking a variable rate, not because that's the best option for them, but because that's the option that they're able to qualify for. So I think we're going to see the government swing the pendulum in the other direction on policy to be able to, make some of these policies a little bit easier to offset what's happening in the market with rising rates.
Yeah, and should the consumer, and I'm sure many out there are wondering, and the thoughts crossed my mind more than once. Once the Bank of Canada decides that they've achieved what they hope to achieve with regards to slowing down, if not stopping, inflation by raising the interest rates, will we see a revert back to where we were? I don't think we'll go back, but even if not back to the record low rates we had gotten used to, will we see a drop in interest rates? Should we be expecting and anticipating that? And I guess as part of that question, as someone who's looking to buy, should we possibly be having a second scenario that no, we need to just consider that rates will be higher going forward?
Let me add to that question, Mike, yeah. and that is, Shubha, from your perspective, your dialogue with regulators as well as industry insiders is, will the rate of default or will the rate of people who are seeking alternative financing to assist with debt management play a factor in the Bank of Canada either continuing to raise interest rates or adjust their aggressive policy right now?
The great thing about the Canadian economy and the Canadian, financial markets and housing markets is that we see very little default on the housing market side of the business. Mortgages are the last thing that Canadians are ever going to default on, and they work very hard to ensure that they can maintain and keep their homes, keep their credibility, and keep their mortgages in good standing. Right now, all data shows us that Canadians aren't defaulting right now. Usually credit cards are the leader. So people start missing payments on credit cards first, then lines of credits, then car payments, then, into your mortgages. We haven't seen it yet in the early stages, which is a great sign, obviously driven by, record low unemployment and the fact that Canadians have jobs, have income to be able to service the debt. The other thing that's really helping us right now and will continue to help us was the stress test that was introduced a couple of years ago. I mean, it was built literally for this moment in time where we're seeing these rising interest rates. There's not many Canadians that have been qualified for their mortgage at less than, 4.75% or 5%. So we already know that these homeowners have the ability to withstand these rises in interest rates, which is going to be a good sign and minimize those defaults even more.
Yeah. So when we come back from the break, all this great information in there, and I appreciate that. When we come back from the break, let's actually go a little bit deeper into what do we anticipate the consumers are going to have to get used to in terms of all these new changes. Are consumer expectations going to change in terms of what they buy, how much they buy, what type of home they buy, and even where they buy so that they can continue to qualify for home ownership? And in fact, even let's talk about what's it going to take to get into home ownership in terms of where those sources of down payment are coming from, and will we see changes in terms of what is acceptable in terms of getting into home ownership? So stay with us after this break. We'll be back with more from co-founder and CEO of Pineapple, Shubha Dasgupta. Welcome back to Hitting Home with Mike and Arif on Rogers TV in Barrie, and we are thrilled to be joined by co-founder and CEO of Pineapple, Shubha Dasgupta. And Shubha, you're also past president of the Canadian Mortgage Brokers Association. One of the reasons why we're thrilled to have you on the show, obviously a finger on the pulse in what's going on in the industry and in the housing and mortgage landscape. And Shubha, before we went to break, we were talking about obviously technological changes, changes in the environment, changes in the economy, things that are spurring or stimulating changes in interest rates, etc. And of course, you were also reminding us of things about, for example, why we had things like a stress test to prepare us for exactly the situation that many Ontarians or Canadians find themselves in, which is a changing environment. So a question that I have for you, Shubha, is really this, is what's next? What can consumers expect? How can consumers anticipate things will move forward in terms of gaining access to home ownership? And one of the things that we've often talked about on the show is different types of built form or housing types, or is it going to be different in terms of who's getting together to get into home ownership? Is it going to be friends or co-workers who maybe share something in common who will combine forces to get into home ownership? What are your thoughts on that?
The one thing that's certain is that change is constant, right? And, we talked about a lot of change here on this episode. My hair color is changing, Arif, since we've known each other. But the way Canadians buy homes is going to change as well. And, who they do this with is going to change. So a couple of the trends that we're seeing right now, and just before I share the trend, I'd love to just share a quick story, I think, that'll help, summarize this or visualize this for Canadians. We think that change and affordability is something that's, a today problem or something that's a problem of our generation. But I'd like to rewind the clock. My parents immigrated to Canada 50 plus years ago, actually. And when they wanted to purchase their first home in the late 1970s, early 1980s, they had the same problem of affordability. They wanted to buy a home in, a nice pocket of the city that they lived in, but those homes were unaffordable and interest rates were in the double digits, the teens, 18, 19%, and they couldn't afford that home. So they ended up having to look a little bit further and, get a home deep into, suburban communities and suburban life that was very far from transit, very far from, their workplace. But that's what they had to do to adopt and adapt into home ownership. And that's very similar to the time that we're living in right now, as we continue to talk about affordability prices and affordability and home prices. It's no different than it was then, where many Canadians are just having to look in different geographic areas or get creative with how they're entering home ownership. Now, some of the ways and some of the trends that we're seeing right now, certainly co-ownership is beginning to, starting to uptick in terms of Canadians that are buying homes with others, other family members. We're seeing more multi-generational homes. And this is something that's, very common in other places in the world, in Asia, in Europe. We see a lot of multi-generational housing where parents, grandparents, and children all live together, and the children qualify with their parents later in life for bigger and larger properties. We're starting to see more friends purchase together to get into the home market, start building equity, and start building resources that they can use to grow their wealth. We're seeing much more gifted down payments right now. More and more Canadians are transferring wealth, and parents are trying to give their children a head start into home ownership by gifting them larger down payments so that they can purchase. And we're also seeing the use of secondary suites as a way to enter home ownership. So is there a basement apartment that can be rented out? Is there the potential for laneway housing that could be rented out? So many different changes into how Canadians are entering home buying, but nonetheless still entering home buying.
And these changes come at a good time. I just want to say at the beginning, talking with reference to your parents, one thing that frustrated me most about that was the reminder that the late 70s was in fact 50 years ago. So, but anyhow, yeah, with regards to second suites, though, that is a necessity for many in order to qualify for purchasing. They need that secondary income But it also comes at a time where our population is growing at a rate where we need that extra bit of housing as well. So it serves twofold. And the other part of that as well is we have an aging baby boomer population that I'm at the tail end of. And that granny suite within a home there is ideal for somebody who is 60 plus, who may be looking for an alternative living environment going forward here, and being able to have that multi-generational home.
Well, it's funny,
it all serves more than just a financial purpose.
As you described that, Mike, I just pictured the front of the U-Haul, over the cab, mom's attic or whatever it is that they basically put there.
The rocking chair on the roof.
Exactly. The reality, though, is, Shubha, for the last, 4 and change years on this show, we have sort of push people's buttons just a little bit, just to say, the way we do things here traditionally as Canadians is actually a little bit abnormal compared to the rest of the world. And Shubha, you referenced that earlier, compared to Europe and Asia and South Asia, with multi-generational homes, or what you're sort of affirming. I don't know that that's factual. We can say that that's factual, but let's have this conversation in a couple years from now and look back at this episode, but of friends getting together or family members getting together. And one of the things that really challenges perhaps Canadians and Ontarians is the whole idea of the home should be mine, and I want the home to be mine. And where we're challenging that is let's do what it takes to get into home ownership first. And so it's not that it diminishes the emotional attachment to it, and it makes it purely transactional, but getting in is that first step. Getting
first
in
rung
is
of the ladder, as I say.
First rung of the ladder. And there will be, again, when you surround yourself with good guidance and good advice from a great lawyer and a great broker and a great realtor, et cetera, getting in with a friend in a first home is the first home. It's not necessarily going to be your
the dream home.
Last home. It might not be your dream home, but let's get in, and there will be a very home ownership is that number one contract in all Canadian law that is most coveted and protected by the court system. So if you have what's referred to as a tenants in common relationship, even if it's not a 50-50 relationship where both parties, if there's two, are coming in with the equal down payment, the contract set up by the lawyer can ensure that you're protected, whether it's 70-30, 80-20, or whatever it is. But getting in, and then you build equity together, and then when it's time for one to move on, or you rent it out, or whatever it may be, their options are available to ensure that it is successful. Thoughts on that, Shubha, though, in terms of educating the consumer as to why this may be a very logical and intelligent and attainable route to get into home ownership?
Arif, it reminds me so much of one of many sayings that I love in the real estate world, which is it's impossible to time. There's no timing the market. It's about time in the market. And it's how much time we have, because historically, and history tells us that the more time we spend in the market, the more our wealth will grow. So the earlier we can get in, the better for us. And that's why we're seeing a lot of parents, transferring their wealth early to their kids, because they know this, they've learned this lesson. If I can get my kids a head start in home ownership, it's not I'm giving them money, and it's not money is going away. It's actually an investment into them and into their future. So I certainly feel that more and more Canadians, should look at, different ways and different strategies to get into home ownership, because it'll certainly help put them on a better path towards building wealth, and then towards that freedom of having their home, as you said.
And with all of this in mind, we've covered a lot of great stuff, but I wish we had more time to cover even more. What do you think, Arif?
Well, I think what the show comes down to is an affirmation that education matters, and an informed consumer matters, and all of us involved in the industry doing our part to ensure that we continue to keep that bar high in terms of professionalism. So with that in mind, Shubha, I can't think of a better guest that we could have had on the show with us today. Please continue to do all that you do in terms of advocacy and leading the charge forward with embracing intelligent use of technology. With that in mind, Shubha, last thoughts?
Last thoughts is, in any market, there's always opportunity. So make sure you get educated, get informed, and find the opportunity that's right for you.
Fantastic.
Very well
Shubha
said.
Dasgupta, co-founder and CEO of Pineapple and past president of the Canadian Mortgage Brokers Association, and my friend. Thanks for joining us on Hitting Home.